Good afternoon, everybody. Welcome to the 2020 Pre-Retirement Webinar. My name is Bob Christoffel, the Manager of Benefits Education at Wespath, and with me I have some of the Benefit Education team, Frank O'Brien and Ronald Theodore. It has been a very busy pre-retirement season. All of our events have been done virtually, including this one. We have a lot of material to cover with you this afternoon. Before we jump into it, just a couple of important announcements. This webinar is being recorded, so if you want to view it again, or those that could not make this live session will have the ability to view it at any time. We have 5 attachments in the toolbox that are yours and available for clicking and printing, including the housing allowance exclusion, information on Clergy Retirement Security Program, United Methodist Personal Investment Plan, and some other attachments. We have had unprecedented demand for this pre-retirement webinar, so it's great to see so many participants interested in the retirement process. I just want to let you know that this is not one-stop shopping. There will be plenty of support available along the way, including the benefit education team. We have a retirement team at Wespath. We will also be doing retirement seminars in the spring, as we do every year. We do want to hear and answer your questions throughout and maybe even after this webinar. Frank and Ron will be working behind the scenes answering as many questions as they can. If you have very personal, specific questions, I encourage you to sign up for a benefit education consultation. These are live, virtual, one-on-one meetings with someone from the benefit education team. We started this program in April, and it really has been very successful. We will continue to run that program throughout the remainder of this year, as well as into next year. So let's sit back, relax, and have a great webinar together, and fire away with your questions to our BEs who will be working behind the scenes. I put together an overview of the topics that I'd like to cover. And I think it's important to begin with the retirement process, just to get you in that retirement frame of mind, things that we should be thinking about now, perhaps actions or changes that we should be making now in anticipation of our upcoming retirement. Then we're going to talk a lot about the Wespath retirement plans. I think that's very important to identify these different sources of income that you'll have available from Wespath. And we'll start with where we exist right now, which is the Clergy Retirement Security Program, or CRSP. Some participants call it CRISP, but I know what they mean. Then we'll go into the Ministerial Pension Plan, or MPP. Many of you on this webinar, I'm sure, have a pre-82 benefit coming. That's the Minister's Reserve Pension Fund, another source of monthly income. And then it's very important to talk about the voluntary plan, the United Methodist Personal Investment Plan, and through that plan, how you can make a significant difference in your retirement income. Following that, we'll go into a very important tax break for retired clergy, the housing allowance exclusion. But we'll look at it as it pertains to you in your retired relationship with the annual conference. And the last topic we'll cover is the services that are available to you through Wespath. I want to talk about the benefit projection tool. I want to talk a little bit about benefit access and the importance of getting yourself involved with benefit access and getting yourself registered for benefit access. So let's first look at the retirement process. And most of you that are eligible to retire should have received a communication from Wespath outlining these important things to start thinking about. These are the things that you need to do next if you are considering retiring next July 1st. I would start by verifying all your personal information on benefit access. If you've never registered for benefit access, I would start with that step. It is very easy now to register for benefit access. You don't need to wait to receive a confirmation in the mail. You can do it very quickly. So what type of personal information? You want to look at your address. Many of you might be moving in the future. Always keep your address current. Wespath needs to keep in touch with you during your active ministry as well as into your retirement. You'll also want to verify other information like your most current email address, like your phone number. That is very important and can be updated right through Benefit Access. Some additional things to think about. Think about your spouse. Verify that information is accurate on Benefit Access. And you might be thinking, well, why is the spouse's information important? Well, some of your benefits, your spouse is entitled to receive a survivor benefit. So it's important to have that there. So when we do the calculation, your projections and ultimately your retirement benefit will be correct. Second very important thing that you can verify on Benefit Access is your clergy service record, or CSR as we call it. And that's a record reported to Wespath from the annual conferences of all your appointments over the years. Why is the clergy service record important? Well, we will use service to calculate some of your retirement benefits, such as CRSP, the Clergy Retirement Security Program, defined benefit component. Also think about life stage investment management. Over 80% of our participants are utilizing life stage to help manage their defined contribution accounts. Take a look in Benefit Access at your profile. Maybe this is something you haven't checked previously. Verify if your risk tolerance is correct, conservative, moderate, or aggressive. Verify if your benefit commencement date is up to date and actually what you're thinking at in terms of a retirement date. Utilize the tools that are available on Benefit Access, such as the benefit projection tool. And that's a really important one because you're going to be taking kind of a camera and shooting it into a calendar to take a look at income at a future date. And that can be done on Benefit Access, running many different types of scenarios. For example, different benefit commencement dates, different surviving spouse percentages, different UMPIP contributions, a lot of different assumptions you can change right on Benefit Access. Other things to think about as you head toward your retirement, think about healthcare benefits. Those are very significant and a very important part of your retirement planning. Check in with your annual conference staff on healthcare plans for retirees. In addition, EY, Ernst & Young, Financial Planning Services, available to you now, and for anybody that's eligible, also available to you in retirement. But start to have those calls. Start to have those discussions with EY. Examples of what a lot of clergy call EY about as they approach retirement. Number one, to see if they can actually afford retirement. Number two, if they're leaving a parsonage and maybe purchasing a home for the first time, how much they can afford on a house, and what is the best means of securing a down payment for that residence. So continue to utilize EY. They can assist you throughout this retirement process, and that's in addition to the benefit education team. That's in addition to the retirement team at Wespath, as well as your annual conference events. At some point, 120 days before your retirement, you need to tell someone. You need to notify the bishop, the cabinet, the board of ordained ministry, and your annual conference. And that step might sound obvious, but it's very, very important. Once the annual conference is notified of your upcoming retirement, Wespath will change you to an intends to retire, or an ITR we call it. And that'll make some changes to benefit access so that you can go through benefit access to actually make your elections in the spring before your retirement date. So plenty of steps along the way. Those are just some important things that we should consider before we can talk about what's going to be important: money. And where is that money going to come from? What sources of income, maybe even in addition to the Wespath retirement plans, will you have available? But we will start with the Wespath retirement plans. Beginning with where we exist right now, under the Clergy Retirement Security Program, again, CRISP or CRSP. And that has both a very important lifetime benefit, a defined benefit component, we'll call it, DB, as well as an account balance with a lot of flexibility. We'll call that DC. Second plan we'll look at is MPP, and that's the Ministerial Pension Plan, which existed from 1982 through the end of 2006, and then gave way to CRSP. And MPP both has a annuity component, 65% of your balance, as well as 35% continuing to be invested, a flexible cash account balance. Many of you will have a pre-retirement benefit coming, the Minister's Reserve Pension Fund, and that provides also a lifetime of monthly income for you and continuing to your surviving spouse. Each annual conference sets the surviving spouse rate. Some conferences have a formula benefit and a defined benefit service money, which we'll look at in a few moments. But let's put all these plans together now just to see what they look like. Currently, CRSP, and you might notice two different boxes for CRSP, two different periods of service, and for the defined benefit, two different calculations to come up with a monthly benefit. Then you have MPP, and then you had pre-82. But wait, there's something missing here. There's one more plan, the voluntary plan that I hope you are taking advantage of now and in the subsequent months and years before your retirement. United Methodist Personal Investment Plan, kind of operating independently to the side there, but UMPIP is a very important plan. But we'll begin our discussion looking at some important provisions for retirement, which are clearly outlined in the Book of Discipline. There are different types of retirement, and you should begin to have some good clarity on what type of retirement you are looking at. The most common one that we see is your normal retirement. You've reached the age of 65 or 40 years of service. Very important, not and 40 years of service, but or 40 years of service. That entitles you to your full benefit and is considered a normal retirement. Early retirement is as early as age 62 or 30 years of service. If you go out under early retirement provisions, for some plans, you will receive a reduction in your benefit for the early commencement. And I do have a good example of that. Mandatory retirement is when you reach the age of 72, and that's when you shall retire, no later than that. A 20-year retirement, you see this come up every once in a while. The clergy person has served for 20 years, separated from the denomination for whatever reason, and they'll come back to Wespath at a future date to collect the benefits that they are entitled to. And that could be as early as age 62 or waiting till normal age 65. We'll begin, though, with CRSP, just to dive into it a little bit deeper. It's a hybrid plan. It's got these two very important but very different components. It's got the defined benefit piece, and that's a monthly direct deposit that you can't outlive. If you live to be 100, you'll still get that monthly direct deposit. And if elected, at the time of your retirement, that benefit will continue to your surviving spouse upon your death. So that's a real important component. And something that makes it interesting, and this comes up from time to time, your CRSP defined benefit does not appear on your quarterly statements. And I'll explain why in a moment, simply because it's not a balance. It's a defined benefit. Your monthly benefit is done using just very simple, easy to understand math, which I will explain. Plus, you have the other component of CRSP, which does appear on your quarterly statements, and that's the defined contribution component. And that's been made up of contributions on your behalf. There's a non-match of 2% of your plan compensation and a 1% matching component. But in order to get that 1% match, you will have needed to contribute to what? The voluntary plan. Correct. The United Methodist Personal Investment Plan. So you really have this two important components, the lifetime benefit continuing to your spouse and this very flexible account balance with different options. I always tell those retiring, whether it's at a retiree webinar or retirement seminar, on-site or virtually, focus on the defined benefit component first. Those decisions are harder. Those decisions are not revocable. Those decisions you make not today, not tomorrow, but in the weeks and months before your July 1st retirement date, when you should have a better, clearer understanding of things like, are you married? Are you divorced? Are you widowed? Are you in good health? Is your spouse in good health? What other sources of retirement income will I have available to me and my surviving spouse? So let's look at that DB component first. Again, these decisions are not revocable, and I always think it's good practice to understand the choice that you made and the 5 choices that you did not make. You have 6 different annuity types to choose from, and I firmly believe it's important to understand all of them. The defined benefit, again, it's not a balance. It's a formula. We multiply 3 different components together, come up with a dollar amount paid on an annual basis, and then we simply divide by 12 to come up with a monthly benefit. So let's look piece by piece at these 3 components. The first multiplier is a factor. And simply put, that's either going to be 1.25% or 1%. The second we look at is the denominational average compensation. Third factor that's multiplied is years and months of credited service. So let's break this down a little bit more. The factor for the first piece of service under CRSP from January 1st, 2017 through December 31st, 2013, the factor we use is 1.25%. Due to General Conference of 2012, the factor changed for service but not beginning until January 1st, 2014, up until the June 30th of the year before your retirement. In the example that I'll use this afternoon, we'll assume a 2021 retirement and the factor used will be 1%. Second component is the DAC, denominational average compensation. This is reported to Wespath. The DAC is made up of the average plan compensation of clergy, but only those serving full-time appointments. And what we have seen, and when you run benefit projections, what the projection assumes is that we will see continued growth in the DAC as we have historically. From 2019 to 2020, we've seen it grow to 2021. So we know, because it's calculated in advance, we know what the DAC will be in 2021 for those retiring July 1st. We'll use $74,199. Now, the third component is the credited service during that period of time. So if you served in a full-time appointment from January 1st to 2007 through the end of 2013, we'll have 7 years. If you served a full-time appointment from January 1st through June 30th, we'll add an additional 7.5 years, 7.5 years, or 7 years, 6 months. So now we can take those components and we can do the math together in an example of a retirement for 2021. There we see the DAC of $74,199 multiplied by 1.25, multiplied by 7, and we get this annual amount. Now, pension benefits like this are not paid annually, they're paid monthly, so we'll simply divide by 12 to come up with a monthly amount of $541. So now at Wespath, we need to just stop for a second, write down that number, and say, well, we need to also calculate service beginning January 1st, 2014 through, in this example, June 30th of 2021. The math is the same. The only thing that changed is that multiplier. It went from 1.25% to 1%, but the math is exactly the same. We come up with an annual amount of $5,565. Again, this is paid monthly, so we'll divide by 12 to see an amount of $464. So now we just take both dollar amounts from both pieces of service and we simply add them together to come up with a total from CRSP, defined benefit, and in this example, $1,005 per month. So now that we have that number, it's up to you to make some very important decisions, and you make these, again, in the weeks and months before your retirement. you're going to have 6 different annuity options to choose from. 3 of those provide a lifetime of income for you and your surviving spouse. Again, you want to clearly understand all 6 of those, but ultimately you'll only be choosing one. In addition, both for the Clergy Retirement Security Program as well as the Ministerial Pension Plan, there are COLAs, cost of living adjustments, and those are very important for retirees. It is important to keep up with the rate and outpace the rate of inflation in terms of your retirement income. So you'll have a choice, and depending upon what annuity type and what COLA, that will impact the dollar amount that you're receiving. In addition, we had talked about early retirement provisions in the Book of Discipline. Quick example of the impact of an early retirement. In this example, the clergy person is age 63, and they don't have the full 40 years of service. Remember, we said 65 or 40, they don't have the 40. If they had the 40, we wouldn't be looking at any reduction in the benefit. The reduction is 0.5% per month, so 6% per year. In this example, 2 years early is going to be a 12% reduction. If the clergy person had 39 years of service, the reduction would be based upon the service, just a 1 year or 6% reduction. It is a permanent reduction. It is not adjusted when you reach normal retirement age. You will also have choices for a COLA to increase this. It will be a minimum of a 2% COLA. So that's the impact. It really depends upon how early the early retirement is. If it's just several months early, it's not going to be a significant reduction. Now we should focus on the DC component of CRSP. That defined benefit component is certainly important to understand the different annuity types, and I will give you examples of that when we talk about the ministerial pension plan. The DC component is easy. Let's say you're looking at a normal retirement age 65. The first thing to do with your defined contribution accounts, including CRSP defined contribution, is to do nothing. You don't need to take it out. I think it's important to always look at this in terms of your income needs. Some clergy I've spoken to said, well, Bob, I do need that right away. I can't wait. Still others have told me, no, Bob, I can wait. You can continue to self-manage your investments. You can continue to use life stage investment management. The money is available to you when you need it in many different ways. Cash distributions, and they can be partial distributions. It could, if needed, after careful consideration, be a full distribution. Many of our clergy will just simply roll this money over into the United Methodist Personal Investment Plan or another outside retirement plan. You want to consider that very carefully because of the housing allowance exclusion, which we'll talk about in a few moments. You can self-manage these distributions. You can use life stage retirement income, whereby Wespath will look at your consolidated defined contribution accounts and calculate an amount that you can take out on a monthly basis so that it approximately lasts your lifetime. You don't need to do anything until you reach the age of 72, when required minimum distributions must be taken out. Many clergy that I've talked to over the last 6 years are well into it by then. We will always notify you of when required minimum distributions need to be taken. Any remaining balances upon your death, they don't go to Wespath or to your annual conference. They only will go to your designated beneficiary. That's the account balance part. Now let's look at the ministerial pension plan. Okay, a lot about CRSP, both at defined benefit and defined contribution. You might see some similarities in plan design for MPP, the ministerial pension plan. A couple thoughts about MPP. We know it's not the oldest plan. That might be your pre-82 benefit. We know it's not the current plan. That's the one that we just focused on, CRSP, both those two different components. And we certainly know it's not the voluntary plan, okay? That's going to be the United Methodist Personal Investment Plan, which I hope you are taking full advantage of. I like to call MPP, well, it's kind of the one just stuck there in the middle, somewhere between our current plan, CRSP, and the pre-82 Minister's Reserve Pension Fund. So our focus will be on MPP. A couple things to point out. Right now, it's an account balance. So if you're interested in finding that out, you want to take a look at your quarterly statement and you'll see an MPP balance. What happens to it later when you reach retirement? Well, a couple things to consider. Let's say you're looking at normal retirement age 65. You don't need to do anything with your MPP balance immediately. Again, many of our clergy will need this as income right away, right from their initial benefit commencement date. But later on, and I'm glad you asked, it becomes both a lifetime of income. 65% of your balance is this lifetime annuity, okay? So a significant portion of your balance becomes annuitized. And you might be thinking, and maybe you've had bad experiences over the years with insurance sales, people trying to sell you an annuity. For purposes of this webinar, when I talk about an annuity, I'm really just talking about a series of payments, and it will be really a series of direct deposits that last your lifetime. Knowing that next year, next month, next birthday, your benefit is going to stop is very important. It will last your lifetime. And if you look at those two people to the right, there they are very happily making retirement elections, and they're going to choose an option which provides a survivor benefit for the spouse. So in this example, and in many cases, this annuity will last for two people's lifetime, both the participant and surviving spouse. Well, Bob, that's only 65%. You might be thinking, where is the rest? What becomes of that 35%? Well, that continues to be an account balance. Most participants that I see will just simply roll that over into UMPIP. It continues to be invested. When you put them all together now, 100% of your MPP balance on June 30th before you're retiring, 65% becomes an annuity, again with 6 different annuities to choose from and a cost of living adjustment. And then the 35% becomes this very flexible account balance with different distribution options, ability to change, to increase, decrease, partials. I just want to point out here, I think it's a good place to say, the decisions that you make for MPP, the Ministerial Pension Plan, in terms of the annuity option, in terms of the COLA, do not have to be the exact same choices that you make for the Clergy Retirement Security Program defined benefit. They can, and it's allowed, be quite different. So let's take a look at MPP and review where we've been. It's an account balance that's invested using LifeStage Investment Management Service. It appears on your quarterly statements. And again, to just backtrack to my opening remarks about the importance of keeping current and updating your LifeStage Investment Management profile. It's on your quarterly statements, whether you get them electronically or paper. Exactly 65% of your balance becomes this lifetime annuity, which can continue to your surviving spouse. 6 different annuities to choose from. And I'm going to talk about the differences between each of those annuities in a few moments. You also have a COLA option. And one distinction between MPP and CRSP that's worth noting is that for MPP, you can also choose a 0% COLA. For CRSP, the minimum, really the default COLA, cost of living adjustment, will be 2%. The default also for MPP is 2%, but you can, if you want, elect 0 or even a 3%, 4%, or 5% COLA. The 35% continues to be an account balance. So you can get the annuity started, hold back on the 35%, different distribution options, got to take it out by 72, but it gives you some, I think, some important flexibility. Similar to what we said for CRSP defined benefit, I think it's important to focus on the decisions related to the 65% annuity first. Those, just like CRSP-DB, will not be revocable decisions. Regardless of which of the 6 choices, there's no choice that you can make that you say, oh no, I didn't choose wisely, my benefit is going to stop. All 6 provide a lifetime of income to you, and if elected, can continue to your surviving spouse. But you have to make that election at the time of your retirement, not during your retirement. You cannot make any changes. So let's look at the first 3. And I like to refer to these as joint and survivor annuities, or we call it life and percentage annuities. And these are really the standard form of payment for a married clergy person. Life in 70, life in 85, and still one more, life and 100%. And if you're looking at these amounts, and this is just an example for MPP of a clergy person with an MPP balance of just over $400,000. They're looking at a 2% COLA, and they're also looking at a normal retirement age. The annuity types will be the same for CRSP, but the elections you make don't have to be the same. So if you look at this chart together with me, the highest dollar amount you see is $915. We have 3 columns here: the annuity type, payable to you, the retired clergy person, and then payable to contingent annuitant, which often will be the spouse. Keep in mind that we don't pay out both the dollar amount columns at the same time. We pay out the column in the middle first. So the highest number here, $915, is a monthly benefit under the annuity type, life in 70%. So you get $915 a month. Annually, you get a 2% COLA. You pass away, and if elected, your surviving spouse will get 70% of the amount that was payable to you. In this example, $641 a month. And you might be looking at the $641, and you should be thinking about what sources of income will the spouse have? What will the expenses look like upon my death? And you might say, you know what, you come to the decision that $641 is not going to be enough. Let me also consider the life and 85% annuity type. And you'll notice 2 things happen. The amount payable to you decreases, but the amount payable to your surviving spouse increases by a greater amount, to $757 in this example. Again, this is no one's exact benefit. This is just an example. And you might be looking at the $757 and thinking, you know, Bob, that's not going to be enough. Let me also consider the life and 100%. And you will have these annuity types available to you when you go through the retirement process on Benefit Access. And again, you can run benefit projections with different life and annuity selected, again, for each of the plans. So the third option, the life and 100%, provides you with $866 per month. 100% of that amount continues to your surviving spouse with whatever COLA was elected. So that's how the 3, and that's really the standard form of payment for a married clergy person, these life and percentage annuities. 3 additional options are referred to as SLAs, or single life annuity options. And one thing that you'll notice right away with these SLAs is that the amounts are higher. And the reason that they're higher is described in the annuity type: single life annuity, a benefit for only one person's lifetime. And we just don't know how long that is going to be. Things to consider are your health going into retirement. Let's look at this single life annuity. It'll provide you with the highest benefit, but let's say you choose that and you live 33 years in retirement. Very well done. Payments continued for the 33 years. Opposite of that, let's say you pick a single life annuity, and this is really the standard form of payment for a single clergy person, but an optional form of payment for a married clergy person. If a married clergy person wants to choose a single life annuity, you need to tell your spouse, and not just mention it, you need to have them sign a waiver, understanding, agreeing, and consenting to giving up a survivor benefit from your pension. And there might be good reasons to do that. I would encourage you to have a conversation with a financial planner or EY Financial Planning Services. Let's say you pick a single life annuity and after 6 months in retirement, you pass away. Only 6 payments were made and then the benefit ceases. The other 2 options, a life with 5-year certain and a life with 10-year certain, work a little bit differently. I like to call them guaranteed terms because it's guaranteed that payments, monthly direct deposits, will be made at least for the term, if not longer. Again, no option you can choose where the benefit stops for you, but under the 5 or 10-year guarantee, it might stop for somebody else. 2 quick examples. You pick life with 5-year certain, you notice the amount payable to you decreases slightly. You pick the 5-year, you live 23 years in retirement, you get the payments plus the COLA for 23 years. When you die, the guaranteed term is up, payments would stop. Second example, you want to guarantee these payments for a longer period of time, for 10 years. So you look at that number, and again, it drops down to $1,035. You pick the 10-year guarantee, you pass away after 7 years, the term is not up. Somebody that you have designated, and it could be anybody, mother, father, sister, brother, girlfriend, boyfriend, friend, neighbor, whomever you want, niece, nephew, age is not a consideration. They will receive the payments, but only for the remainder of the term, 3 years in this example. So 6 different annuity types, and that's why, again, I think it's important to understand the choice you made, as well as the 5 that you did not make, because there is no changing that once you're set up on the pension payroll after July 1st. Second important decision has to do with this annual increase, and this is very important and also will impact your monthly benefit from the right out of the gate, from your initial benefit commencement date. COLAs are important. You know, I've seen retirement plans that don't have COLAs, and that's not good. I think we all know by now that $1,000 a month today is not the same as $1,000 a month 5 years from now or 10 years from now. So these COLAs help us keep up with the rate of inflation. Yes, the COLA you choose will impact your initial benefit. That is certain. And I have a really good, I think, illustration of the impact of the different COLAs on your initial benefit. And this chart is interesting. And participants, the numbers aren't that important. The dollar amounts are not that important. The ages are not that important. This is really just illustrating the concept of the impact of different COLAs. You know, some COLAs can be very large. You know, a 5% annual compounded increase is very significant. A 0% COLA, and that's the red line here, representing a 0% COLA, that will give you the greatest monthly benefit initially, right out of your benefit commencement date. But every year it's going to be flat. You'll reach a point in time, this crossover point, when you'll actually end up getting the lowest monthly benefit. But for many years, you will have enjoyed a significantly higher payment, sometimes hundreds of dollars a month more because of that 0% COLA. Let's look at the opposite extreme. You know, that's the orange line. That represents a 5% annual COLA, which again is very significant. That will impact your initial benefit, sometimes significantly. But every year it's being increased by 5%, compounded. Eventually, you will also reach this crossover point with longevity. You're actually going to be making the highest monthly benefit. The pink line in this chart represents the default, a 2% COLA, where you have a steady 2% cost of living annual adjustment. And the reason we have 2% as the default, if you look back over long periods of historical inflation data, it's averaged about just under 2%. That's the default, the 2% COLA. But just keep in mind that COLAs will impact your benefits. And that's something, one of those things that you can change and look at different COLAs when you run your different projections. And when you actually are making your elections, you can see the impact of different COLAs. So wow, we've covered a lot of information. We certainly have. And this brings us up to the pre-82 plan, the Minister's Reserve Pension Fund. And this is fairly straightforward because the annual conferences make some decisions for you. You don't have 6 different annuities to choose from. The surviving spouse percentage will be chosen by each annual conference. For most annual conferences, we'll calculate your pre-82 benefit 2 different ways. We'll look at what we call the DBSM, the defined benefit service money, and we'll convert that to an annuity, a lifetime benefit. We'll hold that number aside, and then we'll also look at the formula benefit, which is similar in terms of multiplication, not an account balance, a formula-based benefit. And what Wespath will always do is give you the greater of the 2 calculations automatically. We won't call you up and ask which one you want. We'll automatically give you the greater of the formula benefit or the defined benefit service money converted to a monthly lifetime annuity. And this is just a quick example with a hypothetical past service rate, which is something you're probably familiar with from annual conference. In this example, the clergy person has 5 years of pre-82 service. The past service rate is $674.06, coming up with an annual amount. Again, divided by 12 to convert it to a monthly benefit of $281. We have $75,000 in defined benefit service money. Converted to an annuity is $3,905, again divided by 12. So at Wespath, we're just comparing these 2 amounts, 281 or 325. We'll send you the 325 per month, but we'll also keep an eye on that past service rate to see if it keeps increasing. Eventually, you could reach a point where we cross over to the formula benefit. Fairly straightforward. Each annual conference sets the surviving benefit. So let's look at this United Methodist Personal Investment Plan. Again, this is the voluntary plan. It's a traditional defined contribution plan, technically a 403B, and it accepts contributions from both plan sponsors, employers, whether it's an annual conference or a non-conference plan sponsor. But very important, it accepts participant contributions, and they have to be through automatic payroll deduction. It is just a terrific plan. I participate in UMPIP. You have control, you have flexibility, but what you're really doing with UMPIP is providing yourself with an additional source of retirement income. These plans have really some terrific advantages. You can save money on taxes with before tax contributions. There are different ways to contribute, and we'll focus on those different types of contributions. You have some great services like the life stage investment management, kind of setting your account on autopilot. Matching contributions. That's why it's very important to participate in UMPIP, to pick up the matching contribution. If you're clergy, that's 1% going into where? CRSP defined contribution. Plus the fact that your money is being invested in long-term, socially responsible, sustainable investments. So some real important advantages of participation in UMPIP. You may want to avoid taxes now. You can do that with before tax contributions. You might, and everyone's situation is different, and this is the perfect topic to discuss with EY. Do you need to avoid taxes later? The answer for many of you may be no, I don't. Some of you it might be yes, I do. It would be a good idea, and that could be done through Roth contributions. The plan also accepts rollovers, and rollovers really just means moving money from one place, maybe a prior employer's plan, rolling it over or moving it directly to UMPIP. Some of you might be second career. Maybe you came to ministry late. Maybe you had a prior career with a 401k, 403b, and you are allowed to directly roll that over into your UMPIP. The contribution limits are high. So often I get asked, well, Bob, how much can I contribute? And I always start by saying, put in what you reasonably can afford, but know that the limits are very high. For this year, if you're under age 50, the maximum you can contribute is $19,500. In addition, if you have maxed out and you are or will be over age 50 in the calendar year, you can also do what's called catch-up contributions. and that's an additional $6,500. So all the way up to $26,000 for those that are over age 50. That's certainly a lot. I just want you to put in what you can afford, but I want you to understand, everybody in UMPIP should be able to tell me, Bob, I'm putting in 4%, I'm doing it before tax, and my balance is this, and I'm using life stage investment management. Know that you're allowed to make changes to that at any time. The most common contribution we see is a before tax contribution. Those reduce your taxable income. It's the first thing coming out of your paycheck, not subject to taxes. It grows for your tax deferred, becomes taxable later on when you take it out. Usually, not always, you could be in a lower tax bracket. Plus, clergy have the advantage of the housing allowance exclusion. After-tax contributions should be considered last. You'd want to think about Roth contributions, which were added to the plan, over 5 years ago. Roth is a form of after-tax contribution, but if it comes out later as a qualified distribution, it's 100% tax-free income, as opposed to after-tax, where the earnings on those after-tax contributions are always going to be taxable. So Roth is something to talk to EY about as well, because every situation is different, and I would never say to a group of this size, yes, Roth is right or wrong. I would just say it's worth having that conversation with EY, because you still have opportunities between now and whenever you retire to take advantage. And I've seen participants that when they have a few years left, they really put significant amounts of money into their United Methodist personal investment plan. We talked a little bit about rollovers. That's the portability. So these are separate contribution sources, will be maintained separately on your statements. Just to continue the discussion about Roth contributions, what does it mean to be qualified? How is it going to become tax-free money? Well, a couple things have to be in place. The first contribution, but not every contribution, had to be in the account for at least 5 years. And that clock might have started ticking if you did have a Roth 403B or a Roth 401K. So it's got to be 5 years to be qualified. You got to be at least 59 and a half for it to be qualified. Or in the event that you become disabled or die, it would be qualified. So you can wait. Like even if you have just a few years before your retirement, don't think, hey, I shouldn't do Roth. That's not going to help me, because you can take out Roth balances last to be sure that they secure that 5-year qualification. This essentially is a retirement plan, something that becomes hopefully a different source of retirement income. And the big picture here is what we're trying to do is have these different plans to replace the paycheck, a significant portion of the paycheck that ultimately will go away. So a lot of flexibility here. We've seen people consolidate, participants consolidate their UMPIP with their 35% of MPP, with their CRSP-DC, and maybe they're just not sure how much to take out, but they want it to last their lifetime. They can sign up for life stage retirement income, where Wespath will do that calculation for you. You can take a full lump sum distribution, but you want to think about that very carefully from a tax planning, retirement planning perspective, but it is available. You can take out partial distributions. Let's say you're securing a house, but it needs to be fixed up. You need $3,000 to fix up the roof. You can take out a partial lump sum distribution. Most folks I see will set this up in monthly installments. Either they're self-managing that or they're utilizing that life stage retirement income service. If you're retiring, again, normal, early, okay, or even a little past normal, the first choice with the UMPIP is you don't need to do anything. That money will not be sitting frozen or idle. It'll still be invested, either self-managed, using life stage, hopefully earning, hopefully growing. But by the age of 72, that's when the government has lost its patience and it wants you to start taking something out. Keep in mind, you do have the advantage of the housing allowance exclusion. Wespath will always notify you of the need to take out those RMDs, the required minimum distributions. And like the other accounts we mentioned, the account balances, the 35% of MPP, the CRSP-DC, any remaining balances upon your death go to your beneficiaries. So it's important, even in your retired relationship, to maintain those beneficiary designations. Now, the next area of focus will be on the housing allowance exclusion. And maybe some of you have printed out or downloaded in the toolbox, there is a housing allowance exclusion worksheet, which I'll just show you. But this is a very important tax break for retired clergy, and not just United Methodist Church clergy. Other denominations take advantage of this as well. Think of this, the description I'm going to give you is in your retired relationship with the annual conference. You are going to receive money from where? From the different plans that we've discussed, all of them. We'll call that income. Some of that, maybe a lot of it, in some cases all of it, will be allowed to be excluded from taxation. How much can be excluded? It has to be the least of 3 different considerations. The amount that's designated as a housing allowance by the annual conference, typically that'll be 100%. There's no amount stated, just whatever comes out of Wespath is allowed to be excluded. Doesn't mean it will be excluded, because you also have to look at the other 2 considerations. And this worksheet is really just a good starting point, because in your retirement, you're going to need to have to make a bona fide, legitimate attempt to track housing expenses. And some of those are outlined on this worksheet. Whether you're renting, paying rent payments, utilities, if you have a mortgage, mortgage principal, mortgage interest, real estate property taxes. So you want to keep track of those actual expenses on your primary residence. And the third is, what is the fair rental value of that property? Whether it's a home, a lake house, a condominium, a trailer, what is the fair rental value of that property with furnishings and utilities? Often I've been told by clergy that are in retired status, they had a real estate person come over, look at the property, look at comparable rentals in the area, and provide them with substantiation of what this would rent for with utilities and furnishings on a monthly and on an annual basis. So once you have these 3 numbers on your worksheet, your work is done. It's very easy to determine the exclusion. And I'll just give you a quick but very straightforward example of the housing allowance. You have a retired clergy person and they're getting $2,000 a month from Wespath. What plans? Well, let's say CRSP defined benefit, they're taking MPP, the 65% annuity. It just equals $2,000 a month. They've used their worksheet and come up with an annual amount of mortgage interest, real estate property taxes, utilities, etc., and that's $20,000 a year. They had the real estate person come over and help them determine on an annual basis this residence would rent for $21,000. So they have the 3 numbers. It's easy now. The exclusion is the one in the middle, the actual housing cost. The exclusion cannot exceed $20,000, and that means the amount subject to taxation would be just $4,000. That's a really important tax break. And this is something that we can go into further detail on our benefit education consultations. The BEs would be glad to discuss this with you, provide you with the worksheet, and go through some additional examples. This is what the worksheet looks like, and it's really just a great starting point. The EY Navigate website also has a terrific calculator for the housing allowance exclusion. Shifting gears into benefit access. One of the action items from this webinar, if you have not registered for benefit access, please do so. I mentioned earlier, it's very easy to do. And this has all of your account information. It's been redesigned. It's easier to find things. It's easy to use the benefit projection tools. We mentioned updating that information before, like addresses, beneficiaries, even addresses for your contingent or secondary beneficiaries. Take a look at your life stage profile. Use the retirement readiness tool. It is not enough from a retirement planning perspective to just look at income. What you want to do is establish, is there a gap between what your anticipated expenses will look like and the income sources that are available. So those 2 tools used together, the retirement readiness and the benefit projection tool, is a really good starting point. A lot of information on our investments, the funds, we mentioned beneficiary designations, and just a tremendous amount of resources on benefit access. The benefit projection tool, a couple things I'll state. You can run as many of these as you want. There are assumptions in there. You can change that. It's going to come up with normal retirement. Maybe you're looking at age 68, so you change it to that July 1st of whenever you'll be 68. You can change the assumptions on account growth, assumptions on growth of your plan compensation. I mentioned the retirement date, the surviving spouse benefit. It's going to be set at life in 70. You can see what the other amounts will yield. Life in 85, life in 100. You can look at what different COLA options will bring you, what impact they'll have on your initial amount. This is what a benefit projection looks like. This is the output, which you can print out. And many of you I know have done this already, and you'll know this. It's broken down into two sections. The top part is the lifetime income, and it's going to have two different rows likely for CRSP, the defined benefit. Those are just the lifetime ones on top. Then you're going to have a projection on your 65% of MPP. If you do have a pre-82 benefit, you'll find it on top. And then you have a subtotal for the lifetime income. The middle section looks at your account balances, and that would include the 35% of MPP, your clergy retirement security program defined contribution balance, as well as your UMPIP. And you're going to see monthly amounts there. And you might be thinking, well, where are you getting those monthly amounts? On page 3 of the output, it'll have projected balances available to you on day 1, July 1st of whatever future year that is. That's where those monthly amounts are coming from. It assumes that you might want to use life stage retirement income. That's the calculation using life stage retirement income. Those monthly amounts with a tendency to provide you with an increase each year. On page 2, you'll see some of the assumptions used, like how much are you contributing to UMPIP, what surviving spouse benefit did you elect. So just a great tool. If you need help running that, or you want the benefit education team to run different scenarios, we would be glad to do that for you or with you. EY Financial Planning Services, I mentioned a couple of different reasons why you might want to call EY. Just a terrific relationship our denomination and Wespath has had with EY over a long period of time. EY has helped a lot of participants. They've helped me over the years. I just don't want you to think that EY is limited to retirement topics or limited to things as they relate to Wespath. It could be a couple of the things I mentioned today, like trying to buy a home, maybe for the first time. How much can I afford? What is the best way to secure that direct deposit? I want to think about Roth contributions over the next few years. Do I indeed have enough income to retire right now? Do I need to delay that retirement? Help you come up with an estate plan. Maybe you have significant stressful debt and you need a plan to help reduce that debt. Or maybe you're just trying to come up with a savings plan for either your children or even grandchild's education. EY can help you with those types of topics. For many of you that maintain a balance of $10,000 with Wespath in retirement, you can continue to utilize those EY services in your retirement. Certainly they can include your spouse or your spouse's financial situation in that discussion. A couple things that we should do, action items are important, and I've mentioned a few as we've gone along. Register for benefit access, double check those beneficiaries. That's just so important. Think about your contributions. If you haven't reviewed this in a long time, or maybe you're just not sure how much you're contributing, think about not just the amount, but how you're making those contributions. Get into benefit access, verify that profile for life stage investment management, use those benefit projection tools. And if you're stuck along the way here, pick up the phone, call EY, or just click on this link. And this link will be sent to you. And it's very easy to schedule these benefit education consultations. They're unlimited. They're 30 minutes. I had one clergy person that has done 6 consultations. They finally retired last July 1st. We love to see you. You know, I've been in more parsonages over the last 8 months or so than I ever have been before. Often the spouse might be on camera with the participant or slightly off camera. If they're shy, they can certainly are welcome to be part of the conversation. These have just been, 99% of these have been virtual where we see each other. It's just terrific. So I encourage you, if we didn't get to your very specific individual question, this would be a great opportunity to spend some time to take those very important next steps in your journey toward retirement. So we look forward to serving you in that capacity for the future. And I think it's just been such a rewarding program, not just for me, but for the benefit education team as well, and for the participants. And that's what it's all about. You know, as our mission, you know, is caring for those who serve, and particularly of importance is those that are heading on this journey toward their retired status. This is just a reference point. You have this on all the print material, your statements. The Wespath Participant Solution Center, terrific group of people there to help you. That's where you get in touch with the retirement team as well. Benefit Access, the website, EY Financial Planning Services, and not just the financial planner line, but they also have a terrific website available to you at no direct cost. So take advantage of that website and all those resources that are part of that website. I know we've run just slightly over. I do want to sincerely thank you all. It's been very humbling to see this overwhelming response to this webinar. It just tells me that there is a lot of interest in the retirement process, that our benefit education needs are being utilized. So I just want to thank you for being part of this. The recording will be emailed to you, as well as the benefit education consultation link. I just want to thank you sincerely for all your years of service, all your years in ministry, and for all the great things that you have done and will continue to do. God bless you. This is now the conclusion of the webinar. Thank you so much for your participation.